Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 8th of January, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. We're going to go through our Monday run through, which is a little different, and then we'll take a look at what I like to call the shape of the week. So we'll take a bigger picture look. I know we're day trading here at Trade Day, but nevertheless, good practice to know what's coming up in the week. More stuff coming up later in the week. Unlikely to be as much volatility at the beginning of the week. So it could be less volatility if we've got a lot of data coming up in the second half of the week. And therefore, we might need to slightly adjust our day trading tactics at the beginning of the week if we think there's going to be less volatility. So we'll take a look at the shape of the week, looking back at the major events from last week to the beginning of the year, and taking a look at what's influencing markets in the coming week and today. We'll have a briefer look than usual at the charts as well. So if you're relatively new to Trade Day, you may not be aware, but we put out a weekly recap and outlook. It's called Macro Matters, and there's also a shorter like a summary of that. So we have the Trade Day Macro Matters. That's in where you're watching this. If you're watching this live, just below where you're watching, you'll see the fundamental reports next to where the technical analysis reports. So the fundamental reports, I usually upload these at the weekend. The weekly reports are the Trade Day Macro Matters, and then there's also the weekly recap as well, okay, which is like a shortened version of that, just a bullet point version of that. So if you want to read into more depth in here, you've got the Trade Day Macro Matters, and then if you want to look at the summary, then we've got the weekly summary. So on the weekly summary in here, you'll see, let's have a look at what happened last week. Well, we know that stocks and bonds are both lower in here, lower bond prices, higher bond yields weighing on stocks. And this is partly, I think it's partly was like beginning of year jitters. We'd obviously had a really strong run up in November, December. We spoke about this last week. So a correction of maybe an overbought condition that we had into the beginning of the year. And then maybe also we got from the Fed minutes. We didn't get really any clarity from the Fed about when the rate cut timings would start. Obviously, the market has positioned itself very much now looking for an earlier cut than we previously had after what we've seen as a pivot in December at the December meeting to end rate hikes and move towards rate cuts. The market very much expecting a likelihood of a rate cut in March, and we've been looking at the Fed Watch tool. Quick nod to the Fed Watch tool. So we've got like a 60. What is that? 60. We've got 36% that we won't cut. So 64% that we will cut in here. This has been higher than this. It's been up, closer to 70%. And the combination of these two columns in here, we get a 70% chance of a cut and above even. So kind of slightly fading chances of an earlier rate cut as early as March. And that has then seen bond prices go down, bond yields go up, and bond yields going up, negative for stocks, and an anticipation of not as aggressive move in here, maybe a not as early a move from the Fed. I've seen stocks sell off as well. So we saw that was the one of the main driving forces for this correction we've seen. But the correction has started before then anyway. I think it was just a technical reaction to an overbought condition in the market from the strong rally we saw November through December. The data is actually positive. It may be as well in here. I think we spoke about this in the last quarter of last year. Positive data, if it's too positive, the market is now actually, and when I say the market here, I'm talking about the stock indices. So stock indices are kind of reacting negatively to positive data if it's overly positive, because then the market is concerned that then if the data is looking strong. So we had PMI data last week from both S&P Global across the globe, okay, from UK, US, Eurozone, Asia. We had also the ISM PMI data for the US, and most of that data for both the services and non-services and the composite data in here was mostly better than expected. So it's showing a resilience to the global economy. Also, the data we had on the US jobs market, US labor market, the ADP data on Wednesday, and the US official employment report on Friday were both better, stronger than expected. And so the combination of those as well, it's almost now we're getting to the point where if the data is good, too good data, almost want the data. If you're an equity bull, okay, you want the data to be kind of, coming in around in line with expectations, even potentially a little bit worse than expected, which is kind of counterintuitive. We're actually seeing markets, the equity markets, selling off on good data. Why is that? Because then the anticipation is the Fed, if the data is good, if the economy is strong, the Fed won't shift as dovish so quickly. And if a less dovish Fed is then means that we don't get rates as low as the market would like and as the market is pricing in. And so we're seeing this kind of counterintuitive move, stronger data, a more resilient market, on jobs market, labor market, and also a resilience to the economy as being shown in the PMI data, is being actually taken as negative for stocks. So I think we saw some of that last week. So what happened was we saw US stocks and global stock indices actually notably lower. Bond prices down across not just the US, European bonds in here, all selling off, going to higher yields, to multi-week higher yields. The US dollar index went higher. Why did the US dollar strengthen against most currencies? Because higher US yields potentially in here, equaling more attractive to own US assets, US bonds. And so the dollar rallied in here because of the interest rate differential. Interest rate differential is one of the biggest drivers of foreign exchange. So potentially those higher yields that we saw in the US last week benefiting the US dollar. And then on the back of the US dollar gains, remember there's that inverse relationship between the US dollar and gold. So gold futures selling off as the US dollar gained. And oil, with heightened tension in the Middle East, not just Israel, Gaza, but elsewhere, Red Sea, etc. We saw heightened tensions in the Middle East, seeing oil futures pushing higher. What do we have coming in the coming week in here? Well, on the central bank side, things are very, very, very quiet in here. We don't have any major central banks reporting at all this week. But we will continuing to watch out for, as ever, Fed speakers to maybe get some clues as to how much we are seeing a shift from the Fed towards a more dovish potential stance in here. And on the data side, there's not a big lot of data really coming out for this week. But what we do is a super important piece of data on Thursday: US CPI, US inflation data. Is inflation continuing to come under control? If it is, it opens up the door for the Fed to be more aggressive on their potential rate hiking. So we'll certainly be watching that as we go into this week. The other thing that I didn't actually put in here, and I should have probably mentioned a bit, but I was mentioning it on the webinar last week, was that we do have earnings season, the Q1 earnings season, looking at earnings for Q4 and the outlook for Q1. The US earnings season kicks in earnest really on Friday, and I'll come to talk about that and look at that shortly. On the overnights in here, don't forget to use this as well below where you are. So remember, these reports in here in the fundamental section, you've got three sections: the technical analysis section, the fundamental section, and then we also have this daily news feed from our partners at LiveSquawk in here. And so do take a look at that. The standout in here for me was that quantitative tightening in here, the Fed reviving hope that the quantitative tightening strategy is going to end. So that's kind of a dovish shift in here as well. And the market's now looking for, chasing economists, hopeful for a soft landing and a Fed rate cut as we go into this year. So on the technical analysis side, though, what we have seen is bond market's down, as we said last week. So we're bearish across the board in here on most of the bond markets. 30 years, 10-year in here, negative in here, and the 5-year. But the 2-year, we're kind of clinging on. So remember the short end, the 2-year in here, we had a significant sell-off and a rebound in 2-year bonds on Friday. In here, clinging to a more positive tone. And remember in here, the short end is more of a reflection of what's going on with the central bank. The longer end of the curve, the 30-year, 10-year, is more of a reflection of the economy. And if we go and take a look at the indices in here, what we're seeing here as we've gone more bearish in here on the indices, having had that sell-off that we saw in here throughout last week in here. So taking out significant supports on the S&P and previously on the NASDAQ. The NASDAQ leading the way down was the real big underperformer last week, and wiped out multiple supports pertaining to the December up leg of the rally. But if you look at where we are in consideration of the November-December rally in here, we're still way above supports in here for the November-December rally, but certainly wiping out pretty much about half or more than half of the December up leg of the rally that came from, well, it's actually from late October here. And what else do I have for you? So on the data front today, it's super light. As I've said, there's not a lot coming through until we do have bits and bobs coming through in here on the run-in to Thursday's US CPI data, but it's relatively quiet. Consumer credit data, not particularly big. Bostic speaking at midday Eastern time is probably the standout of the day in here. Bostic speaking at midday. Consumer credit numbers rarely really moving markets in here. Let's continue on. And then this is more important, I think, now the investing calendar. I'm going to share this. This is the calendar I'm going to be using. We don't have this on the site. You can't use it as a plugin, unfortunately. So we don't have this on the Trade Day site. But what we do have is we can visit this site, and we will be visiting this as we go into this week. Now, the beginning of this week is fairly light in here, okay? And what I want you to do is when you're going to use this, I'm going to click on filters here. Now, if you're trading individual stocks separately, obviously you can do what you want in here. But what I've got it ticked as is United States, and I want you to tick this one in here. This is what I'm going to be doing when we review this, and it's the 3 stars. So you can see in here when we tick the 3 stars, there's hardly anything coming up for this week, and it narrows it down to starting off on Friday, okay? Because we've ticked that 3 stars. The 3 stars being the bigger corporations, okay? And you can see we kick off in earnest on Friday with the financials. The financials always lead us into the earnings season. JP Morgan, Bank of America, Wells Fargo, BlackRock, Citigroup, and Bank of New York Mellon are all reporting on Friday, along with United Health. So that's going to be earnings season kicking off on Friday, and we'll revisit that as we come closer, as we go into Thursday, Friday on the webinars there. Let's take a look at this 5 things to start your day. Remember, you can sign up to this on the Bloomberg homepage. I've shared this with you guys before, but once more for those who haven't seen it. So in here, Bloomberg homepage, bloomberg.com/markets. I'm sharing that in the chat just below the streaming video now. Bloomberg.com/markets. You come over to the right-hand side here, enter your email here. They release 3 of these 5 things to start your day on a daily basis. One for the Asian time zone, one for the European time zone, one for the US time zone, and they come out in the mornings of each of those time zones. So I get into my inbox, the European one comes in between 6 and 7 a.m. and you get like a recap of what's happened overnight. This one that we're going to look at in here is for the US. Okay, so this is the US one that's come out in the last hour or so. Look, so like 11:30 GMT. This came out 1 hour ago, and so it's just looking. So rate cut narrative last week was dominated by fluctuating bets on when they will start cutting rate, okay? And it will remain, it says the dominant narrative. It certainly will. It's going to be the most important thing we focused on as the Fed shifts from more hawkish to more dovish. How aggressively do they shift in here? Big week for Bitcoin. Deadlines are failed to fall to mark the culmination of a year-long push to launch ETF. So ETF, we're getting some decisions on that as we go into this week. When is it? Yes, securities are until January the 10th. So that will be interesting in here. Boeing in here. Boeing has been smashed in here. Where are we down at the moment? Down by 10%, I saw already. And Boeing shares have fallen 9%. I think it's down as much as 10% now in US pre-market trading on the back of issues with one of the 737 MAX 9 planes in here. And more issues for Boeing. They've been in and out of with issues over the last 5 to 10 years. China in the midst of reshaping the economy toward manufacturing away from its struggling property sector. We all know about the property woes. I think those property woes are in the rear view mirror, and looking forward to a more positive outlook for China going into this year. And stock futures are lower in here this morning so far. Stocks resume drop. Not massively lower this morning, slightly lower, but being pulled down. Boeing not really helping that matter in here. But oil significantly lower in here. Saudi has cut price. Saudi's price cuts, and so that's offset some of the Middle East. So we've had a 3% drop in the oil price, having a significant rebound last week in here. So that should be positive for stock. Oil drops as Saudi pricing cuts counter Middle East supply risks. And another, again, from Reuters in the oil slides, as Saudi price cuts counter Middle East worries. So yeah, same headline actually. We've already spoken about the Fed Watch tool. Let's have a quick nod to the overnights in here. So the Nikkei was slightly up, significant drop, nearly 2% down for the Hang Seng this morning. European stock indices mixed, with the UK FTSE down 0.3, the DAX and the German DAX little unchanged, and the CAC from France only down 1/10. And looking into this morning, we're down about a tenth in here on the major US indices. So not particularly negative. The Dow Jones, why is the Dow down more? Because Boeing is a part of the Dow. And remember, the Dow Jones Industrial Index is a price-weighted index. And so the Boeing has a large price. Most indices, so the S&P and NASDAQ, for example, are market capitalization weighted. So bigger stocks have a bigger impact. Apple goes up and then NASDAQ goes up a lot, right? And S&P goes up a lot on the back of maybe the Magnificent Seven, as we're calling them, the FANG stocks that are in the NASDAQ and in the S&P. Because it's a market capitalized weighted index on the market cap, how big the company is, what's the value of the company. The Dow Jones, however, is a price weighted index, meaning that the bigger the price, the stock price, not the value of the company. So you could have a smaller company with a big stock price, so it's calculated on the weighted price index on the pricing. And Boeing has a large stock price, and so Boeing down nearly 10% today is tugging down the Dow Jones. That's why the Dow Jones is particularly down today, with the S&P and the NASDAQ less impacted. A quick nod to the charts in here. So we had this kind of erratic session during the employment report in here for both the S&P, this long-legged doji, sometimes a turning point. So as bearish, and you've got a similar in here on the NASDAQ, okay? So as negative as I am going into today, okay, if you look at the technicals that we looked at earlier in here, I'm still looking negative. Should we claw back above some resistance points in here today, particularly if we get back up to Friday's highs on either the NASDAQ or the ES in here, if I step into the 30-minute chart. So getting back up to here, it's going to need a move all about to like 47.60, but maybe even as much through 47.45 and 47.60 on the ES, on the S&P, and on the NASDAQ. Ultimately, we want to be up through here like 16.575, 585, but even above 16.510 could signal a bottoming process going on in here, but we'll have to wait and see. Maybe what we're watching out for is some kind of information as we go through. And where are we on the calendar? Maybe a little bit of a nod from Bostic today could help us out, okay, on the upside, because we had a significant sell-off last week. But at the moment, going into it bearish, but should we claw back above those resistance points, it could easily turn back to more positive in here today. I'm going to wrap it up there if there are no questions. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back to you with another Bull versus Bear webinar tomorrow. Bye.